What's up, guys? I wanted to go through this because people were asking, like, what do you mean when you say distressed sellers, not distressed assets, when we're targeting assets for Fund One? And here's some of the things that we're looking for, right? These are the main things, the top four when I'm looking at a deal for our fund and acquisitions. So we're looking for deals that have 3, 5, 7, or 10-year holds, meaning like maybe the owner, the seller, the group that owns this property, maybe they're a merchant developer, a builder. They built an apartment building and they built it 3 years ago. Now it's time to exit that property. Not because of the property that they want to exit in 3 years, it's because their debt is expiring in 3 years. 5 years. Maybe they bought it 5 years ago and now it's time to one, either refinance or resell that property. And maybe their interest rates 5 years ago, which was 2020 or 21, was let's just say that was 3%, 3.25%. Some of these guys got 2.75%, and now the interest rates on commercial debt is somewhere around 5.75 to 6 or 6.25. That's a huge difference. So they can't just turn around and sell, right? They can't turn around and refinance because their payments are going to be, if they're at 3 and now it's 6, that's like a 75% increase in their payments. That's crazy. So they're either having struggles with their debt coverage, or whoever's buying it is going to base it on the new debt today. And they're going to have to put down more money, kills their returns. So they're going to have to buy it at a discount. That means that seller is going to have to sell it at a discount if they need to get out. All right. Or it could be 7 years. Maybe they got 7 year debt. They bought it 7 years ago. Here they are, 2019, somewhere in there that they bought it, 2018, 2019, debt's expiring. Same situation as a 3, 5 year guy. Or 10 years. They bought it 10 years ago. It's a great property. They've executed their plan. And now they're like, hey, we got to either refinance this property or we got to resell it. And the debt market's not friendly. The rates are too high. We thought they were coming down. Now they're not. And here we are. Those are great deals for us because those are typically great properties. The longer, the better, because the equity's there has been built up. These things need time to grow, meaning like the stability of the property. 3 years, not a lot of time to be stable. 5 years, getting on the cuff. 7 years, it's really touching bases. So the next part that we're looking at is debt maturities, which is the same thing as here, but we want debt maturities over the next 12 months. So any deal that says, like, for example, if they built the property or bought the property 3 years ago, their debt is expiring over the next 12 months, they're going to come to market and test the market. They're going to be like, hey, is this time to be able to do that? Let's engage a broker, or a broker will engage them, and then they'll go to market and they'll see what the market will bear, right? So that's important because then if we know we can solve that problem for a seller, let's say a seller is a builder, they built an asset 2 years ago, 3 years ago, their debt is expiring and they're in year three for their debt, and they need to come to market and they know they have 12 months to do it. Now's the perfect time to have a conversation with a broker and find out what will actually solve that problem. What's their timelines? What do they need? How can we be of service? What is it that we can do to buy this property quickly and solve all the seller's problems so they check all the boxes in what's called their process to be able to exit? Next, we're looking for below replacement costs. So if we can buy a property for below what it costs to actually replace that property or what it costs to build, like if it's in a builder standpoint, which that's kind of across the board. If it costs 700,000 to build, but we can buy that same asset for 400,000 or 450 or 375,000 per door, that's a huge discount on below replacement cost, which is what everybody's looking for. Or we can buy it for below what it traded for last. There was a property that we took a look at that they bought it for 120 million in 2019. That property guidance was 90 million, and I'm sure it probably traded below that. There was another deal that we took a look at, same scenario. So these are properties that were built. One, they were built for like to replace them and build today, scrape the land, rebuild. It'll take 2, 3 years, no cash flow whatsoever while we're waiting. And it'll also cost somewhere around $600,000 to $700,000 to build. But we can buy this property for below what they paid for it. Let's say they bought it for that and they built it for that. And now we're buying it for below what it cost to build and below what they bought it for. That is a crazy great deal, which is what we're looking for the fund. Now, like I keep saying, these are nice assets. These are not distressed assets where they're struggling assets. They're performing, but there's a debt issue. There's a distressed seller that has to sell, that doesn't want to sell. That's really the key. Then last thing we're looking for this fund, for the assets that we're looking for acquisitions, are locations. Like I'm a location junkie. Like we looked at a great property, brand new properties coming to market. It is massive. But the question is, will this property be able to maintain occupancy and could we continue to get the best people in here? Because the property is in a minus B plus location even though it's brand new and it's beautiful. So an A plus 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 location is typically what I'm looking for because if I can find a motivated seller, a seller that has urgency, the debt's expiring in the next 12 months, the maturity is in the next 12 months. They bought it 3 years, 5 years ago. They have to trade out of this thing. We can get it below replacement cost, preferably and hopefully below below last trade, below what they paid for it, or at least equal to what they paid for it. And our property's at an A plus plus location, and we know we can score on this deal. That's a great deal for the fund. So when people have asked me like, what are we looking at? And why are we looking at it? Why are we focused on distressed sellers, not distressed assets for this current fund that we have? And what is this major push? Because right now, over the next 12 to 18 months, this is going to be the time that a lot of groups, institutional players, merchant developers, and some institutions that own these assets that's been riding the fence, hoping and waiting for the debt to come down before they enter the market. They have to do it now. You have big institutions, Starwood, Blackstone, a lot of these guys gated redemptions, meaning their investors wanted their capital out, which is the play here. Equity wants their money out, or debt needs to be recycled. That's happening. So at some point, it's going to be guys like myself who have a fund that's going to come in, know this business, have the relationships with the brokers, and then we can get access to these assets before the rest of the market does, or before Fannie, Freddie, or any debt funds or life insurance company says, hey guys, you need to kick the keys back, or the groups kick the keys back. So that's why we're doing what we're doing. Like I said, those things are very important. Those four things. One, 3, 5, 7 year debt, that's happening. The debt matures in the next 12 months. We're either picking it up below replacement cost or below what it traded for last. If we can do that, that's great. And we need to be in an irreplaceable asset, or I'm sorry, irreplaceable location for that deal to work. I'm more worried about the location than I am the asset. Because if you can control a great asset at a time when in a group, an institution, or anybody that has a fund or syndicators have got the best location, and we can lock that up and we never lose it and we never leave it, that location will always command a premium for our investors. That's what we're doing. So I hope that helps. I hope that answers the question. Let me know. Leave it in the comments. And let me know how I can help with anything. If you're interested in getting more information about what we're doing with our fund, go to bell-capital.com. You can do two things there. You can schedule a call with myself or somebody on the team, or you can go ahead and hit get started and it'll take you to the portal. You can register your account and you can do your research. You can take a look at our open fund, go through, review the documents, and then you can still schedule a call with us because we're here for you to answer your questions. All right. So I hope this helps. Let's get after it. Let me know if you need anything.